Hey, how's it going, guys? Welcome back to the Module 4 of Options Trading Foundation, the complete options trading course for beginners. Module 4 is all about the advanced options trading strategies that are suitable for beginners. In this video, the sub-module 4.4, we will cover the very last option strategy which I want to share with you guys in this beginner course. It's called the cutter, and we will wrap up the entire course by giving you guys one last case study on Apple stock. And you will learn how to use cutter strategy to lock in any price range you want on any stock. Alright, let's get started. Unlike all the other option strategies that I will talk about in this course, cutter is probably the only strategy that is not designed to make any direct profits for investors. So what exactly is a cutter? Simply put, cutter is an option strategy that is purely designed to focus on hedging a large stock position in a long-term investment portfolio over a certain short period of time. It's also commonly known as the hedge wrapper among institutional investors. To construct a cutter position, you have to own the underlying stock first. The main goal of using a cutter strategy is not to make any profits, but this strategy can allow investors to put on a nice zero-cost hedging position using both call and put option contracts to protect their existing unrealized profits from a long-term stock position. So when is the best time to use this cutter strategy? When you have a long position on a certain stock that already has a pretty good unrealized profits since you invested, but for some reasons you're worried about the short-term market correction or crash that could affect your returns. But you don't want to close this long-term investment position because you still believe it will continue the bull run in the future. Especially if you're at an institutional level, closing one large position not only will cost a huge amount of transaction fees, but also, even more importantly, it can cause a massive fluctuation on this stock, and it will directly affect your potential return. So basically, all you want is just to lock in the current price over the potential bear market so that it won't impact your entire portfolio performance. Then the best way to do it is definitely using the cutter strategy. There are mainly two ways to construct a cutter trade to meet two different investing objectives. First, if you want to lock in a very specific price, then here are your trade legs. You buy one at the money put option with your lock-in price as the strike price, and simultaneously you sell one at the money call option with exactly the same strike price. But I have to highlight one thing here is that in the real world of investing, very rarely you will see people to lock in a very specific fixed price. More usually, investors use cutter to lock in a price range, and this is how you do it. First, you buy one all of the money put option with a lower strike price, and then you sell one all of the money call option with a higher strike price. These two different strike prices will be the price range that you can lock in your underlying stock position. So basically what you're doing is that if the stock price goes up, the loss from selling call option will be offset with the gains that from your underlying stock. On the other hand, if the stock price goes down, you will have profits from your put option and the losses from your underlying stock position, and they will cancel each other out. Both of your profit and loss will be limited between these two strike prices, and that is exactly what you want when it comes down to protecting a large long-term position in a market correction or crash. Alright, now let's take a look at one case study on Apple stock and see how exactly you can apply cutter strategy in your own investment portfolio. Let's say Apple stock is currently traded at $100 per share in October 2020. You own 200 shares of Apple stocks in your portfolio. You plan to keep holding this large position as a long-term investment because you strongly believe Apple has one of the best long-term growth potential out there in the market. However, the problem is, due to the unexpected COVID pandemic, you worry that Apple stock might be negatively affected by the broad economic recession over the next 6 months. You don't want to close this position, but also you don't want the potential big losses on Apple stock to drag your entire portfolio year-to-date performance. You're looking for a strategy that allows you, no matter the stock market goes up or down over the next 6 months, your Apple stock position won't be affected that much. Your ideal range for Apple stock to fluctuate over the next 6 months is from $95 to $105. Then the best way to do it is to use cutter, and this is how it works. First, you buy two April 2021 put options on Apple stock at a 95 strike. They're all of the money contracts and are currently selling at $4.7 per contract as the premium. Then you sell two April 2021 call options on Apple stock at a 105 strike. They're also all of the money contracts with the same premium price. After you complete these two trade legs, the premium you pay for your put options will be offset with the income you generate from selling call options. So basically, you just put on a zero-cost hedging trade that locks in your Apple share price between $95 to $105. One thing to highlight here is that sometimes the premium of the put options and the call options may not be exactly the same. But the good news is that because both of them are out-of-the-money options, the premiums will be very close. And that is the main reason we choose out-of-the-money options for this kind of trade legs. Alright, now let's take a look at the risk graph of this cutter trade and visualize how exactly it helps us to hedge our Apple stock position. The entire risk graph for cutter is probably the easiest and the most straightforward among all the option strategies. First, we have our lower strike price at 95 and the higher strike price at 105. Because it's a zero-cost trade, the premium you pay for a put option is already offset with the premium you earn from your call option, so there's no break-even price for this cutter trade. Your both profit and loss will be limited. So basically, you use this cutter trade to lock in your Apple stock position in this price range. So what will happen after you put on this trade is that your Apple stock position can only affect your portfolio if the price stays within this range. If the stock price crashes and it goes below 95, your downside will be protected. But of course, if the stock ends up going up and it breaks above $105, your return on this position will be capped as well. So the cutter is only used as a pure hedging trade. Cool, before we wrap it up, there are two very important tips on cutter that every beginner should know before you use this strategy. First, you probably wonder, there's so many other hedging strategies that I can use with options. Why do we need cutter to limit both directions of our position? Well, the answer is because something called the performance chasing. For retail investors, we may not have this problem, but for large hedge funds and institutional investors, their each year's annual return on paper is extremely important for their business. And the cutter strategy is a very important tool for them to lock in their unrealized annual return, especially at the year end. Cutter works the best for those stock positions that have very large position size in a long-term investment portfolio, especially those positions that have already accumulated a very substantial amount of unrealized profits. Institutional investors often use cutter to lock in their unrealized profits for their annual return performance without the need of closing their positions, realizing their returns, and paying high tax over them. Also, a big selling could potentially cause the price crash even more, which will have a negative impact on the total return. Second tip, the best time to build a cutter position is when the stock is approaching the end of a bull cycle with a parabolic move to the upside. Because in that case, the call options will be priced way much higher than the put options. You will be able to buy puts at a discount and sell calls at a premium to create a credit into your account as an instant income when you put on such a cutter trade. Such opportunities don't happen very often, so whenever you spot such opportunities in the market, you should take advantage of them. Alright, that will conclude this entire options trading course for beginners. It will definitely take a lot of time and effort to master the game of options trading, and I hope what I share with you guys in this entire course could be valuable to help you kickstart your journey in the world of options trading. If you have any questions or suggestions, do drop me an email or DM me on Twitter. I would love to hear from you guys and continue providing more educational content to help your investing journey. Again, thanks so much for watching guys, and I'll see you guys soon.